Before we begin, take a moment to relax. Put your phone aside, let your shoulders drop, and gently close your eyes if you'd like. You're about to enter a quiet journey into the heart of global finance, told calmly, clearly, and without noise. And if you enjoy falling asleep to knowledge-rich stories like this one, make sure to subscribe so you won't miss future journeys like this. Let's begin. Imagine waking up one morning, sipping your coffee, and scrolling through the financial headlines. Markets are up, stocks are shifting, governments are adjusting policies. But behind all of this, often unseen and almost never named directly, is a single powerful entity managing trillions of dollars. That name is BlackRock. BlackRock is not a household brand. It doesn't sell phones, cars, or food. You won't find it on store shelves. And yet, it may quietly influence the companies that make all of those things, and the governments that regulate them. BlackRock is a financial firm, specifically the world's largest asset manager. As of today, it oversees more than $10 trillion in assets. To put that in perspective, that's more than the combined GDP of Japan and Germany. BlackRock manages the money of pension funds, insurance companies, governments, and millions of private investors. But most of all, it manages power, not overtly, but silently, efficiently, and with deep access to global markets. It doesn't own all this money, but it controls how it is invested. That gives BlackRock extraordinary influence. It can vote at shareholder meetings. It can direct capital into or away from companies. It can even help stabilize entire economies during crises. But how did such an invisible force come to be? To answer that, we have to go back to a time of economic upheaval, growing debt, and the emergence of digital finance. In the early 1980s, the world of Wall Street was changing. New financial products were being invented, computers were entering the trading floors, and among a new generation of financial minds, one man was beginning to stand out: Larry Fink. Fink didn't set out to rule the world's financial arteries. His early work was focused on a small corner of the bond market, but through a mix of strategy, technology, and timing, he would go on to shape a firm unlike any the world had seen before. This firm would avoid the spotlight, operate behind the scenes, and ultimately become a kind of invisible infrastructure of capitalism. In the next part of this chapter, we'll explore BlackRock's early days, the lessons learned from failure, and how it built its empire from the ground up, not by accident, but by deliberate design. To understand how BlackRock became the world's largest asset manager, we must begin with a man and a lesson. A painful, defining lesson that would shape his entire philosophy on risk, transparency, and control. That man is Lawrence D. Fink, known to most simply as Larry Fink. In the early 1980s, Fink was a rising star at the Wall Street firm First Boston. He had helped pioneer mortgage-backed securities, a relatively new and innovative financial product at the time. Under his leadership, the firm made billions. He was seen as a visionary, a risk-taker, and a data-driven strategist. But in 1986, something went wrong. One of Fink's bets, a large position in interest rate derivatives, backfired due to unexpected market movements. The loss was over $100 million, and though it wasn't entirely his fault, the experience had a profound impact on him. Fink realized that in finance, information is not optional, it's survival. The problem wasn't risk itself. The problem was not knowing where risk lived, not seeing it clearly, not having systems that could model it, monitor it, and react to it in real time. That idea, that transparency and technology could transform finance, would become the seed of something much bigger. In 1988, together with 7 partners, Fink left Wall Street to start a new kind of firm. It was called BlackRock. Unlike traditional investment houses, BlackRock would focus on risk management through data. Its mission was to build systems that could see deeply into financial portfolios, model thousands of scenarios, and help clients, from pension funds to governments, make smarter, safer decisions. At its core was an internal software platform named Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. Aladdin wasn't just a tool. It became the brain of BlackRock, capable of analyzing risks across vast portfolios, simulating shocks, and guiding investment decisions at a scale never seen before. This gave BlackRock an edge. While other firms focused on high-risk trading, BlackRock focused on infrastructure, the invisible plumbing of finance. It became a trusted manager of retirement funds, insurance assets, and sovereign wealth. Clients didn't just want returns, they wanted safety, clarity, and insight. Over the 1990s and early 2000s, BlackRock grew steadily. It acquired other firms, merged with competitors, and expanded globally. But always, quietly. Never flashy, never loud. By the time of the 2008 financial crisis, BlackRock had already become a major force in institutional investing, respected, trusted, and deeply embedded in the world's financial systems. But it was the crisis itself that would elevate BlackRock to an entirely new level. In the next chapter, we'll explore how the collapse of Lehman Brothers, the panic across markets, and the urgent need for stability led governments, including the U.S. Treasury and the Federal Reserve, to turn to one private firm. That firm was BlackRock. To understand the scale of BlackRock's influence today, we need to understand the person behind its DNA. Not just his role in the company, but the ideas that shaped his worldview and the philosophy that runs through BlackRock's core. Larry Fink was born in 1952 in Van Nuys, California, into a modest, middle-class Jewish family. His father owned a small shoe store, and his mother was an English professor. It wasn't a world of finance, and yet it provided something essential, a sense of discipline, work ethic, and curiosity. These early influences would shape Fink's commitment to structure, responsibility, and measured risk. He studied at the University of California, Los Angeles, and later received an MBA from UCLA's Anderson School of Management. Like many finance professionals of his generation, he entered Wall Street at a time when it was transforming, from a traditional handshake-driven environment into a data-rich, tech-fueled battlefield. At First Boston, where Fink began his career, he quickly rose through the ranks. His ability to understand complex fixed-income products made him stand out. He was analytical, pragmatic, and unusually cautious for a rising financier. But ironically, it was a massive failure that became the turning point of his professional life. In 1986, Fink's team suffered the now famous loss of over $100 million on a single interest rate bet. For some, it might have ended a career. For Fink, it was the beginning of a transformation. He became obsessed with understanding risk, not just reacting to it, but anticipating it, modeling it, managing it. This obsession would lead him to a core realization. Financial institutions didn't need more speculation. They needed clarity. They needed to see risk the way a pilot sees a cockpit, not just the destination, but the turbulence ahead. When Fink co-founded BlackRock in 1988, his mission was clear. This would not be a firm focused on flashy returns or short-term trading. It would be built on long-term thinking, deep analysis, and powerful technology. He wanted to build a firm that would become the nervous system of global investing. From the very beginning, BlackRock was different. It wasn't a bank. It wasn't a hedge fund. It wasn't even a traditional asset manager. It was more like a platform, a system of systems, a quiet operating layer that allowed other financial actors to see, measure, and manage their portfolios with precision. And central to this vision was a software platform that few outside the financial world would ever hear about, but which would shape markets around the globe. Its name was Aladdin. Aladdin, short for Asset, Liability, and Debt and Derivative Investment Network, began as an internal tool within BlackRock, but it quickly evolved into something much bigger, a comprehensive risk analysis and portfolio management platform used by banks, insurance firms, pension funds, and even governments. At its core, Aladdin wasn't just a dashboard or a database. It was a real-time simulation engine, able to process thousands of financial variables across millions of assets. It could run stress tests, model economic shocks, and give its users a high-definition view of their exposure, not just today, but under dozens of possible future scenarios. Fink understood that in a world increasingly driven by volatility, this kind of insight was more than valuable. It was essential. And because Aladdin was developed in-house, BlackRock had full control over it. That meant they weren't just using the tool, they were building and evolving it constantly based on what the markets were doing. By the late 1990s, BlackRock had carved out a unique niche. It wasn't the biggest player yet, but it was deeply respected by institutions that needed precision and stability. Insurance companies entrusted them with capital. Pension funds saw them as a partner in safety. Governments saw them as neutral and data-driven. But Fink's vision was never about becoming a loud giant. It was about becoming an essential utility, like electricity or infrastructure, something you don't always see, but always depend on. And with that philosophy, BlackRock kept growing. In 2006, the firm made a defining move by acquiring Merrill Lynch Investment Managers. This nearly doubled its assets under management and expanded its global footprint. A year later, it was already managing more than $1 trillion. That figure would multiply dramatically after the events of 2008. But even before the crisis, BlackRock had become a central node in the global financial web. Through Fink's leadership, BlackRock positioned itself not as a competitor to governments, but as a service provider to them, offering data, stability, and guidance in times of uncertainty. By the time the global financial system began to crack in 2008, BlackRock was already the firm with the tools, the team, and the reputation to step in, not to dominate headlines, but to help hold the system together. In the next chapter, we'll dive into the financial crisis of 2008 and how BlackRock, still largely invisible to the public, suddenly became the most trusted name behind the scenes. In most stories of financial power, the central characters are people, CEOs, bankers, politicians. But in the case of BlackRock, one of the most important characters is not a person at all. It is a software platform, vast, invisible, and quietly watching over trillions of dollars. Its name is Aladdin. To most people, the word Aladdin might evoke images from folklore, a magical lamp, a genie, a hidden world of power. In some ways, the real Aladdin shares that mystique. But this Aladdin doesn't grant wishes. It measures risk with extraordinary precision. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. It is BlackRock's internal operating system, a massive data-driven platform that tracks, analyzes, and simulates the risks of financial portfolios across the globe. The scale of what Aladdin does is difficult to grasp. At any moment, it monitors over 20,000 investment portfolios representing more than $20 trillion in assets. That includes portfolios managed not just by BlackRock, but by hundreds of other institutions, pension funds, sovereign wealth funds, insurance companies, and even central banks. Aladdin is the nervous system of modern finance. It doesn't just store data, it interprets it. It runs stress tests, asks what-if questions, and provides answers in milliseconds. What happens if oil prices crash? What if interest rates rise sharply? What if a regional war breaks out? Aladdin doesn't panic. It simply calculates. To its users, Aladdin appears as a dashboard filled with numbers, charts, and interactive tools. But beneath the interface lies a vast network of models, algorithms, and databases. It simulates economic scenarios. It maps relationships between assets. It estimates how a small shock in one part of the world might ripple outward to others. This is where BlackRock's quiet power begins to show. Because when you control the tool that others use to see risk, you help define what risk is. Aladdin has become the standard lens through which much of the financial world views uncertainty. It doesn't tell people what to do, but it shows them how things might go wrong or right in astonishing detail. And it goes further. It isn't just about managing financial portfolios. Aladdin also tracks climate risk, geopolitical shifts, supply chain disruptions, and other real-world variables. It integrates public and proprietary data to build a high-resolution model of global exposure. This gives BlackRock a unique advantage, a bird's-eye view of the entire financial system. But how did this software become so dominant? And why do so many governments and institutions rely on it? The answers lie not only in the software's design, but in the trust that BlackRock has cultivated over decades. Aladdin wasn't built overnight. Its development began in the early 1990s, when BlackRock was still a relatively small firm. Larry Fink understood early on that the future of finance would be shaped by data and systems, not just human expertise. So rather than outsource its analytics, BlackRock decided to build its own. They hired engineers, quants, economists, and risk specialists. They didn't aim for speed, they aimed for depth. Year by year, Aladdin grew more powerful. It absorbed new data sources, it expanded its modeling capabilities, and perhaps most importantly, it was tested against real-world crises. During the dot-com bubble, Aladdin helped clients understand tech sector overexposure. During the 2008 financial crisis, it modeled mortgage risk across complex portfolios. During the COVID-19 pandemic, it ran simulations on supply chain failures and economic shutdowns. Each time, it proved invaluable. As a result, other institutions began asking to license Aladdin for their own internal use. Not to give BlackRock control, but to gain insight. Today, Aladdin serves over 200 institutional clients worldwide. For many of them, it is not optional, it is essential. What makes this remarkable is that BlackRock is not just an asset manager anymore. It is also a technology provider, one whose platform underlies vast parts of the global financial system. Aladdin is often described as a kind of financial Google Maps. It shows where the capital is, where it's moving, and how interconnected everything is. But unlike Google Maps, it also predicts what might happen next. It simulates earthquakes in the financial terrain before they happen. This predictive power is what makes Aladdin so influential. It gives its users, and BlackRock, a real-time view of systemic risk, not just in markets, but in the underlying world: climate exposure, energy transitions, political volatility. Aladdin is not conscious. It does not make decisions, but it makes decisions possible, smarter, faster, and more aligned with reality. And for BlackRock, that is a kind of power few firms have ever possessed. In the next chapter, we'll see how this power became visible during one of the most chaotic financial events in modern history, the collapse of Lehman Brothers, and BlackRock's rise during the 2008 global financial crisis. The year was 2008. Banks were collapsing. Markets were in free fall. Fear had spread across every major economy. What began as a housing market downturn in the United States had rapidly transformed into a global financial crisis, the most severe since the Great Depression. In the midst of this chaos, governments, regulators, and financial institutions faced an urgent question: who understood the complexity of modern financial instruments well enough to help untangle the mess? The answer came from an unexpected place: not a central bank, not a government ministry, but a private company, BlackRock. At the time, BlackRock was already managing nearly $1.3 trillion in assets. It was known for its conservative approach, its technology-driven strategies, and most of all, its powerful risk management platform, Aladdin. When Lehman Brothers filed for bankruptcy in September 2008, the financial system was jolted. Major institutions didn't know where their risks were. Credit markets froze. Banks refused to lend to each other. Derivatives were tangled across continents. The U.S. government moved quickly to prevent a total collapse. And when it needed help understanding the exposure inside the most toxic portfolios, it turned to BlackRock. Specifically, BlackRock's Financial Markets Advisory (FMA) unit was asked to step in. Its job was not to rescue the market, but to diagnose the damage. How much bad debt did failing banks hold? Where were the vulnerabilities? How could toxic assets be priced and unwound in an orderly way? BlackRock's team began analyzing the portfolios of firms like Bear Stearns, AIG, Fannie Mae, and Freddie Mac. Their role was technical, but crucial. They had the tools and the trust to handle portfolios that no one else could understand. They weren't bailing out these firms. They were doing something even more precise: mapping financial radiation zones so that policymakers could contain the fallout. This marked a turning point. For the first time, BlackRock wasn't just managing assets, it was helping governments make decisions, not as a regulator, but as an advisor with deep knowledge, data access, and operational tools. The firm's role was quiet but powerful. There were no press conferences, no cameras, just spreadsheets, simulations, and late-night meetings. And the results were transformative. With BlackRock's guidance, the U.S. government was able to better understand and stabilize parts of the banking system. Confidence slowly returned. Markets began to unfreeze. And BlackRock's reputation, once limited to investment circles, became known in policy halls from Washington to Brussels. But this growing influence also raised new questions. Was it healthy for one private firm to have so much insight, and influence over national financial systems? That question would echo louder in the years to come. The events of 2008 didn't just change the global economy, they changed BlackRock's trajectory forever. As the dust settled, it became clear that risk management was no longer optional. Banks, insurers, pension funds, they all needed better tools, deeper analytics, and partners who could help navigate an increasingly complex world. BlackRock was perfectly positioned to provide exactly that. In 2009, BlackRock made a bold and historic move. It acquired Barclays Global Investors, BGI, including a division called iShares, which specialized in exchange-traded funds, or ETFs. The deal was worth $13.5 billion. Overnight, BlackRock became not just the world's largest asset manager, but also the dominant force in passive investing. The use of index funds and ETFs to mirror market performance at low cost. This was more than a business expansion. It was a strategic shift. With BGI, BlackRock gained enormous scale, but also reach into the portfolios of individual investors, retirement accounts, and sovereign funds worldwide. By 2010, the firm was managing over $3 trillion in assets. Its technology, especially Aladdin, had proven essential during the crisis. Now, institutions across the world wanted access to that same insight. BlackRock began licensing Aladdin to banks, regulators, and asset managers. At the same time, BlackRock's Financial Markets Advisory Unit continued growing. It was hired not only by the U.S. government, but also by the Bank of Greece, the European Central Bank, and later, governments in Latin America and Asia. Each time, its role was similar: analyze risk, stabilize portfolios, and help restore financial confidence. But this quiet expansion also raised concerns. Critics began to worry that BlackRock was becoming too embedded in the very systems it was meant to analyze. Could a firm advising governments also remain an unbiased investor? Was BlackRock now too big to fail, or too complex to regulate? The company, for its part, maintained that it did not take political positions. It was, in its own words, a fiduciary, a steward of client capital, committed to long-term outcomes. And yet, the numbers kept growing. More assets under management, more governments seeking advice, more infrastructure dependent on its tools and insights. By the end of the decade, BlackRock was no longer just a participant in the financial system. It had become part of its architecture. In the next chapter, we'll look at how this influence extended beyond crises into the daily operations of government, central banks, and global economic policy making. Not by force, but by invitation. In most countries, when economic uncertainty strikes, it's the job of central banks and ministries of finance to respond. They adjust interest rates, manage public debt, and design policy to steer the economy. But what happens when the complexity of financial markets outpaces the capacity of public institutions? More often than many realize, the answer is, they call BlackRock. BlackRock's rise from asset manager to shadow advisor began during the 2008 crisis. But in the years since, that role has quietly expanded, not just in the United States, but across Europe, Asia, and Latin America. Today, BlackRock is more than an investor. It is also a trusted consultant to governments and central banks. Its advisory arm, known as Financial Markets Advisory (FMA), operates under strict confidentiality agreements. It doesn't make public statements. It doesn't set policy. But it plays a vital role in helping governments understand markets and react to them. In Greece, BlackRock was hired to conduct detailed stress tests on the nation's banks during the height of the European debt crisis. In Ireland and Portugal, it helped authorities assess exposure to troubled assets and design recovery plans. In the United Kingdom, it advised the Bank of England on the purchase of corporate bonds during market disruptions. In Japan, in Canada, in Mexico, the pattern repeated. Each time the mission was not political, it was technical. Map the risks, model the consequences, offer data-driven guidance to stabilize the system. From a government's point of view, the logic is clear. BlackRock has the tools, especially Aladdin. It has the personnel, teams of economists, quants, and financial analysts. And it has the credibility, earned during decades of performance and quiet discretion. In effect, BlackRock became the outsourced brain for financial stabilization. Its role is often invisible to the public. Contracts are confidential, meetings are private, outcomes are folded into national policies with few signs of outside involvement. But the implications are significant. A private firm, unelected and largely unknown to citizens, is helping shape public policy, not by lobbying, but by analyzing and advising behind closed doors. And it doesn't stop with financial crises. Even in normal times, central banks use BlackRock's insight to test economic scenarios, design bond buying programs, or evaluate climate-related risks to the financial system. This is not a conspiracy. It's a form of outsourced expertise, a recognition that modern finance is too complex for public institutions to navigate alone. Still, the question remains. When one firm becomes this central to policymaking, without ever appearing on a ballot, what kind of power does it really hold? To understand the scale of BlackRock's influence in public policy, consider its involvement during the COVID-19 crisis. In March 2020, as markets plummeted and credit froze, the Federal Reserve of the United States turned once again to BlackRock. Its task: help design and manage the Fed's emergency bond buying programs, including purchases of corporate debt, a first in U.S. history. The selection of BlackRock was not put to a public vote. It was handled internally, under emergency powers. But the implications were massive. Through its FMA division, BlackRock helped structure the programs, select eligible securities, and carry out purchases, including of funds that BlackRock itself had created. The firm took steps to mitigate conflicts of interest. It created firewalls between its advisory and asset management units. All activity was monitored by the Federal Reserve. Fees were disclosed. Still, the optics were powerful. A private firm was executing public monetary policy, not as a vendor, but as a partner with strategic influence. And this wasn't an isolated case. In Europe, BlackRock advised the European Commission on integrating climate risk into banking regulations. In Germany, it worked with the government on sustainable investment frameworks. In Canada, it helped pension funds prepare for demographic shifts and interest rate changes. These projects are not scandalous. They reflect BlackRock's capacity and the modern state's reliance on specialized expertise. But it raises a philosophical dilemma. Should governments, institutions accountable to voters, rely so heavily on a private entity that is not democratically accountable? Should monetary policy be implemented, even in part, by firms that also serve private clients? BlackRock argues that its advisory work is nonpartisan and technical. It provides insight, not direction. It does not make final decisions. It simply helps leaders make more informed ones. Yet the firm's reach is extraordinary. It sits at the intersection of public power and private capital, advising the architects of policy while simultaneously managing the savings of millions. No laws have been broken, no regulations have been bypassed. But in an era defined by growing skepticism of elite institutions, BlackRock's position raises an uncomfortable reality. True influence often operates in silence. In the next chapter, we will examine the mechanisms of that influence in the corporate world through ownership, voting rights, and the passive power of index investing. If you were to list the largest companies in the world, Apple, Microsoft, Amazon, Google, ExxonMobil, and then ask who owns them, the answer might surprise you. It's not a single billionaire. It's not a government. In many cases, it's BlackRock. More precisely, BlackRock holds significant shares in these companies through the passive investment funds it manages. And through those holdings, it exercises voting rights, helping to shape decisions on executive pay, environmental policy, and corporate governance. This is not unique to BlackRock alone. Other asset managers, such as Vanguard and State Street, also hold massive stakes in global corporations. Together, these three firms are often referred to as the Big Three. But among them, BlackRock is the largest. Much of this ownership stems from the rise of ETFs, exchange-traded funds. An ETF is a type of investment vehicle that tracks an index, like the S&P 500 or the NASDAQ. When you buy a share of an ETF, you are effectively buying a small slice of hundreds of companies at once. It's simple, low cost, and extremely popular. And BlackRock's ETF business, known as iShares, is the largest in the world. Through iShares, BlackRock channels the investments of millions of people, from teachers and nurses to institutional investors and sovereign wealth funds, into public markets. But because BlackRock is the legal owner of the shares in these funds, it also retains the right to vote on behalf of the investors. That means BlackRock, though managing money for others, effectively holds voting power across much of the corporate world. For example, as of today, BlackRock is among the top 3 shareholders in nearly 90% of S&P 500 companies. It doesn't control these firms outright, but it can influence key decisions, especially when aligned with other large shareholders. This raises profound questions. Can a company that invests passively still exercise responsible governance? Should firms like BlackRock speak up on issues like climate change or labor rights? And who decides how those votes are cast? BlackRock argues that it acts in the long-term interests of its clients. Its stewardship team engages with companies, studies their policies, and casts votes based on a structured framework. But critics say that too much power is concentrated in too few hands, and that passive investing may be eroding corporate accountability. It's not just the size of BlackRock's holdings. It's also the scale of its presence across sectors. It owns parts of energy companies, tech giants, healthcare firms, banks, and even defense contractors, often all at once. This creates complex incentives. What if 2 companies BlackRock holds are in competition or in conflict? The firm's official position is clear. It is a neutral steward, focused on financial performance, not politics. But neutrality becomes harder to define when your influence spans every corner of the economy. In the next section, we'll explore how BlackRock manages this influence, and whether its efforts at transparency are enough to reassure regulators, investors, and the public. BlackRock is well aware of the concerns surrounding its growing corporate influence. In response, it has taken steps to make its stewardship process more transparent. Each year, it publishes detailed reports on how it votes in shareholder meetings. It outlines its positions on topics such as climate risk, board diversity, and executive compensation. The firm has also created a dedicated investment stewardship team, a group of professionals tasked with analyzing company behavior and engaging with executives before casting votes. These interactions are often quiet, behind closed doors, and focused on long-term financial outcomes. Yet despite these efforts, the scale of BlackRock's power continues to raise alarms. The core issue is index concentration. Because ETFs are designed to track indexes, they cannot easily shift away from underperforming or controversial companies. If ExxonMobil is in the S&P 500, BlackRock's S&P 500 fund must hold it, no matter what. And as more money flows into passive products, more power flows into the firms that manage them. This has led some academics and policymakers to call for reform. Should voting power be redistributed to individual investors? Should index fund managers be required to abstain from certain types of votes? Or should the industry move toward a model of pass-through voting, where investors choose how their shares are voted? BlackRock has begun to experiment with this. In recent years, it launched a program called Voting Choice, which allows large institutional clients to vote their shares directly rather than delegating those decisions to BlackRock. The firm has also signaled its openness to expanding this to retail investors in the future, though the logistics remain complex. At the same time, some regulators worry that these steps don't go far enough. With trillions under management, BlackRock's influence may be too systemic to leave to self-regulation. Still, it's important to recognize that BlackRock does not act alone. It competes with other major firms, it answers to clients, and it operates within a web of legal obligations. But no other firm sits at such a central point in the global capital system, managing public retirement funds, advising central banks, and owning parts of nearly every major public company. The result is a form of silent control, not through backroom deals or hostile takeovers, but through the quiet routine mechanisms of passive investment and fiduciary duty. In the next chapter, we'll explore how this influence has become a target, not just of academic criticism, but of public suspicion, political pressure, and conspiracy theories. What's true? What's exaggerated? And what does it reveal about how modern power really works? As BlackRock's assets, influence, and visibility have grown, so too has a wave of public scrutiny. Once a quiet background player in global finance, the firm is now the subject of academic debates, political critiques, and, increasingly, internet speculation. Some view BlackRock as a well-run, efficient financial engine that helps stabilize markets and allocate capital. Others describe it as a shadow government, quietly pulling strings behind the scenes. The truth is more nuanced, but the concerns, both real and imagined, reflect deeper anxieties about concentrated power in modern capitalism. Let's begin with the legitimate criticisms voiced by economists, regulators, and public interest groups. First is the issue of systemic influence. BlackRock is not just a participant in the financial system, it is part of its infrastructure. It manages pension funds, advises central banks, analyzes climate risk, and holds voting power in thousands of public companies. This creates a potential conflict of interest. For example, If BlackRock is advising a government on financial stability while also managing that same country's sovereign wealth fund, can it truly be neutral? If it holds large stakes in competing companies, can it act without favoring one over another? So far, no evidence suggests BlackRock has violated any laws, but critics argue that the appearance of influence is enough to erode public trust. Second is the opacity of operations. BlackRock does not have to disclose many details of its advisory work, especially with governments. These contracts are often confidential. The firm's internal risk models, such as Aladdin, are proprietary. This makes it hard for outsiders to assess how much influence BlackRock actually exercises, and on what basis. Third is the scale of ownership. Through its passive index funds, BlackRock owns large chunks of virtually every major public company. This concentration raises concerns about reduced competition, diluted corporate accountability, and the emergence of a common ownership effect, where the same investors influence supposedly competing firms. And yet, none of these concerns have translated into decisive regulation. Part of the reason is that BlackRock doesn't act like a traditional monopoly. It doesn't set prices, it doesn't suppress innovation. Its power comes not from aggression, but from efficiency, trust, and institutional access. Still, this makes it no less powerful, and in recent years, BlackRock has also become the target of conspiracy theories, many of them unfounded but widespread. On social media and in fringe political circles, BlackRock is sometimes portrayed as a kind of global puppet master, secretly controlling governments, funding both sides of every conflict, or even manipulating major world events. These claims are not supported by evidence, but they reflect a very real discomfort with the idea that one company can have such a broad, subtle influence over so many systems. Some narratives claim BlackRock owns everything. Others suggest it controls media companies, World Health institutions, or political leaders. In reality, BlackRock owns shares in thousands of companies, but it does not own the companies themselves. Its voting rights are exercised as a fiduciary, meaning on behalf of the clients whose money it manages. It cannot use that power to serve its own ends without violating financial laws and ethical standards. Still, the complexity of BlackRock's role makes it easy for half-truths to spread. The firm's visibility during crises, such as the 2008 financial collapse or the 2020 pandemic, has made it appear as a behind-the-scenes orchestrator, when in fact it is often acting in a technical, advisory role at the request of governments. But even when conspiracies are false, they reveal something important: a growing global unease with the blurring line between private and public power. Why is a single firm involved in both market making and policy design? Why are its tools used by both private investors and sovereign institutions? And why does it seem so difficult for citizens, or even lawmakers, to fully understand what BlackRock is doing? These are not conspiracy questions, they are governance questions, and they strike at the heart of how power functions in the 21st century. BlackRock's response has been consistent. It positions itself as a technocratic partner, focused on long-term returns, data integrity, and serving client interests. It does not lobby aggressively, it does not dominate the media, and it publishes detailed stewardship reports each year. But the scale of its influence, quietly exercised, broadly distributed, is unprecedented in modern finance. And that alone ensures that criticism, suspicion, and even myth-making will continue. In the next chapter, we'll explore how BlackRock has tried to respond to these pressures, especially through its public embrace of climate action, environmental, social, and governance investing, and sustainability. Is this a genuine shift in values, or a strategic evolution in response to global pressure? In recent years, one of the most visible transformations in global finance has been the shift toward sustainability. Investors, regulators, and even everyday consumers have begun asking deeper questions. Where does their money go? Does it fund pollution, deforestation, or human rights abuses? Or does it help build a more sustainable world? At the center of this transition stands BlackRock. In 2020, Larry Fink, BlackRock's CEO, released a now famous annual letter to CEOs. In it, he made a clear and powerful statement: climate risk is investment risk. With those words, the world's largest asset manager signaled a major strategic shift. BlackRock would begin incorporating environmental, social, and governance (ESG) factors into its investment decisions. It would push companies to disclose carbon footprints, embrace climate resilience, and plan for a net zero future. The message was not just moral, it was financial. Climate change, Fink argued, would reshape asset values, economic growth, and long-term risk. Firms that failed to adapt would become less attractive to investors. Those that embraced sustainability would be better positioned for the future. But this move was not without controversy. Critics from multiple sides questioned BlackRock's motives. Was this a genuine embrace of climate responsibility, or a calculated effort to polish the firm's public image while continuing to invest in fossil fuel companies? On the one hand, BlackRock took meaningful steps. It exited certain coal-related investments. It expanded its suite of ESG-focused ETFs. And it began to use its voting power to pressure public companies on emissions targets and sustainability reporting. On the other hand, BlackRock still holds substantial stakes in oil and gas giants. It continues to manage funds that include companies with high environmental impacts. And while it offers green investment products, the bulk of its assets remain in traditional index funds that reflect the broader market, fossil fuels included. The result is a complex picture. BlackRock is not an environmental activist. It is a fiduciary, responsible for optimizing returns within the mandates of its clients. This limits how far it can go in divesting from sectors like energy, unless the client explicitly demands it. And yet, BlackRock does have influence. Its letters, votes, and models can steer corporate behavior. Its ESG frameworks can shape what investors consider responsible. Its Aladdin system now includes climate risk analytics, allowing users to evaluate how floods, fires, and regulation may affect portfolios. Still, this balancing act between profit and principle is difficult. In the next section, we'll explore how BlackRock has responded to pressure from governments, activists, and opposing political forces, all demanding that it either do more or do less. BlackRock's embrace of ESG has placed it in a unique and often uncomfortable position. On one side, it faces pressure from climate activists, environmental NGOs, and socially conscious investors. They argue that BlackRock should divest more aggressively from fossil fuels, use its voting power to demand stronger emissions targets, and champion renewable energy transitions globally. On the other side, it faces rising opposition from political and business leaders, particularly in the United States, who claim that ESG policies are a form of woke capitalism. In several U.S. states, politicians have moved to ban or limit public pension funds from doing business with BlackRock, arguing that the firm's climate focus interferes with free markets or discriminates against traditional energy sectors. This has led to a paradoxical situation. BlackRock is being accused simultaneously of doing too much and not enough. In response, the firm has clarified its position. It does not set climate policy. It simply responds to the long-term risks and opportunities that climate change creates for capital markets. Its ESG integration, BlackRock says, is not about politics. It is about risk-adjusted returns. Firms exposed to extreme weather, regulatory changes, or shifting consumer behavior are more likely to underperform. Helping clients navigate those risks is part of its fiduciary duty. But the messaging hasn't satisfied all sides. Some environmental groups argue that BlackRock's climate commitments are too slow and too easy to reverse. They point to continued investments in fossil fuel-heavy companies as proof of inconsistency. Meanwhile, certain states have pulled billions in funds from BlackRock accounts, accusing the firm of ideological bias. This polarized environment underscores a deeper reality. Any firm of BlackRock's size cannot be apolitical. Its decisions, even when made in response to client demand or data, ripple across economies, political systems, and global narratives. BlackRock has tried to thread the needle. It now offers clients a range of ESG options, from climate-optimized funds to standard market indexes. It provides voting choice tools that let institutional investors decide how their shares are voted. And it continues to refine its climate analytics within Aladdin, helping clients understand physical and transition risks more precisely. Still, BlackRock's climate strategy remains under constant scrutiny. Whether praised or criticized, the firm sits at the intersection of finance and the future, balancing the weight of trillions with the uncertainties of a warming planet. In the next chapter, we'll explore how BlackRock is expanding its technological reach, moving beyond finance into data, prediction, and artificial intelligence. Because in the coming decades, the firm's greatest asset may not be money, but the ability to see what's coming next. Throughout BlackRock's rise to financial prominence, one consistent theme has quietly guided its evolution: the pursuit of clarity in a world of uncertainty. Whether through Aladdin simulations, ESG frameworks, or policy advising, BlackRock's true product is not capital, it's insight. And in the 21st century, insight increasingly depends on one thing above all: data. More than money, more than real estate or equities, data has become the most powerful asset class in the world. It tells us where people spend, how economies move, what risks lie ahead, and, increasingly, what might happen next. BlackRock has spent decades quietly assembling one of the most sophisticated data infrastructures in global finance. It doesn't just monitor prices and portfolios, it collects, analyzes, and models an ever-expanding universe of variables: macroeconomic indicators, climate data, market sentiment, supply chain disruptions, political instability, corporate behavior, social trends. These data streams feed into Aladdin, the firm's flagship platform, but they also power newer tools. BlackRock has begun investing heavily in predictive analytics, machine learning, and AI-driven insights that go beyond traditional finance. One initiative involves using satellite imagery and alternative data to monitor global supply chains in near real time. Another models how shifts in agricultural productivity due to climate change could affect commodity prices and food security. Yet another explores how social unrest and policy volatility might influence national creditworthiness. This goes far beyond portfolio management. It is the construction of a global sensing system, capable of helping institutions see around corners, anticipate disruption, and reallocate capital before others even recognize the signals. In many ways, BlackRock is becoming a kind of financial weather service, constantly scanning the horizon and offering forecasts, warnings, and strategic guidance to those in its orbit. But this predictive power raises fundamental questions. Who gets access to the future? What happens when only a few institutions can see risk with clarity, while others remain in the fog? In the next section, we'll explore the implications of this data asymmetry and how BlackRock's vision of financial foresight may shape the way entire economies are governed. In the modern economy, information moves faster than capital, and those who understand change before it happens often define the terms after it arrives. This is the world BlackRock is building toward. Through Aladdin and its expanding suite of data tools, the firm is positioning itself not just as a manager of wealth, but as a strategic intelligence platform, one that can guide institutions through a rapidly shifting landscape. This is particularly visible in areas like climate modeling, where BlackRock now offers clients highly localized predictions about sea level rise, fire risk, and heat exposure, not just globally, but down to individual asset locations. Insurance companies use this data to price future risk. Pension funds use it to de-risk portfolios over decades. Governments use it to plan infrastructure spending and long-term borrowing strategies. But BlackRock's predictive reach is growing in other domains too. Its systems now incorporate natural language processing, NLP, to scan news, earnings calls, and regulatory statements, extracting patterns that may signal emerging risks or opportunities. Its geopolitical models assess trade frictions, election outcomes, and civil unrest, simulating how these variables might affect investment flows or currency stability. In effect, BlackRock is no longer just modeling markets, it is modeling the world itself. And in doing so, it creates a new form of power, not the power to enforce outcomes, but the power to anticipate them and to help shape decisions before others even see the contours of the problem. This has value, but it also creates a profound information divide. Those who have access to BlackRock's systems can see the financial future with greater clarity. They can move capital faster. They can avoid losses before they occur and seize opportunities others have yet to recognize. This divide is not illegal. BlackRock's clients pay for access, and many are public institutions entrusted with pensions, national reserves, or social funds. But the implications are significant. In a world of uneven access to foresight, does prediction become a form of privilege? Do we risk creating a financial future shaped less by shared knowledge and more by who has access to the most sophisticated lens? BlackRock maintains that it is a service provider, not a decision maker. It doesn't dictate strategy. It offers tools to those who seek clarity. But with trillions of dollars flowing through its insights, the difference between advising and directing becomes increasingly subtle. What happens when a single platform sees more risk, earlier and more accurately, than entire governments or international institutions? In the next and final chapter, we'll look ahead toward the possible futures of BlackRock itself. Will it continue growing into a new kind of global institution? Or will its very size invite a regulatory response that reshapes its role in the world economy? As we reach the end of our journey through BlackRock's rise, influence, and inner workings, one question now quietly emerges. What comes next? Will BlackRock continue expanding, not just in assets, but in reach, responsibility, and global centrality? Or will its unprecedented scale trigger a rebalancing, a rethinking of how power should be distributed in the world economy? For now, BlackRock remains a unique entity, neither bank nor hedge fund, neither regulator nor policymaker, and yet it plays roles adjacent to all of these. With more than $10 trillion in assets under management, it has a greater reach than most national economies. Its Aladdin system quietly tracks over 20% of global investment assets. Its executives meet regularly with central bankers, presidents, and finance ministers. Its tools influence how trillions of dollars are invested, regulated, and insured. Some view this as a triumph of technical excellence, a reward for decades of operational discipline, data integrity, and long-term thinking. Others see it as a warning signal, a reminder that modern systems often concentrate power not through conspiracy, but through efficiency and network effects. Indeed, BlackRock's dominance was not built overnight. It evolved through a series of rational choices, better analytics, more scalable products, a reputation for neutrality and discretion. And yet, the result is a firm that increasingly shapes the scaffolding of the global economy, from retirement systems and corporate governance to crisis response and climate modeling. Will this trend continue? Several factors suggest that it might. Demographic trends, such as aging populations in developed countries, are pushing more capital into passive investment vehicles. Regulators increasingly demand robust risk modeling, the kind that BlackRock specializes in. And volatility, both environmental and geopolitical, is turning data-driven insight into a strategic necessity. In this environment, BlackRock's platform model, combining investment management, risk intelligence, and policy consulting, offers something few others can replicate. But not all paths lead upward. In the next section, we'll explore the growing calls for regulation, public oversight, and systemic safeguards, and how these might shape BlackRock's role in the future. As BlackRock's profile has grown, so too have demands for greater accountability. Lawmakers in Europe and the United States have begun asking harder questions. Should a single firm manage both private capital and public advisory roles? Should its proprietary systems, like Aladdin, be subject to public review or transparency mandates? Should index fund giants be required to relinquish some voting power, or at least pass it through more broadly? These are not easy questions. Regulating BlackRock is difficult in part because it doesn't fit existing categories. It isn't a bank, so it's not subject to traditional capital requirements. It doesn't lend money directly. It doesn't take deposits. And yet, its collapse, were it ever to happen, would likely have far-reaching consequences. This has led some economists to describe BlackRock as a too-big-to-ignore institution. In response, BlackRock has taken a careful, proactive approach. It publishes stewardship reports. It cooperates with regulators. It emphasizes that it acts on behalf of clients, not on behalf of its own corporate agenda. It is not the master of global markets, it argues, but a servant of them. But this rhetoric may not be enough in an era of growing skepticism about financial concentration and democratic legitimacy. Some reform proposals include splitting asset management from advisory roles, limiting cross-ownership in index funds, creating independent oversight boards for firms managing public sector contracts, making Aladdin or similar systems auditable by third parties. BlackRock, to its credit, has engaged with many of these conversations. But whether change comes from inside or outside the firm, the broader truth remains. BlackRock is not just a company, it is a system, woven deeply into the arteries of modern finance, climate policy, and national economies. And systems like this, once large enough, require governance beyond mere trust. Looking ahead, several futures are possible. In one future, BlackRock continues to grow, expanding into new domains like artificial intelligence, digital currencies, and climate adaptation finance. It becomes, in essence, a new kind of global institution, private in structure, but public in impact. In another future, public pressure leads to structural reform, perhaps splitting the firm's roles or subjecting it to higher levels of oversight, transparency, and democratic input. And in yet another future, the center of gravity shifts altogether toward decentralized finance, sovereign wealth networks, or new institutions that redefine how global capital is organized. But whatever path unfolds, one thing is clear. BlackRock is no longer just a financial actor. It is a mirror of our times, reflecting how data, scale, and trust can quietly shape the architecture of power itself. As the world faces an age of uncertainty, BlackRock stands not at the edge, but very much at the center.